So today we got the Michigan survey, consumer survey data that came out, and the consumer sentiment index, fell yet again and disappointed relative to expectations. Survey was looking for 72, came in at 65.6. Now it's been steadily down now for several months in a row, and look at the longer term trend here over the last 3 or 4 years. It's been declining. We are in the territory that is usually a signal of an oncoming recession. And if you go on to the next slide, the real interesting thing about the Michigan survey is the long-term inflation expectations, which are at odds with what we saw last week with a declining, or was it earlier this week with declining. With CPI coming in a little bit less than expected, and here we see that consumer inflation expectations are actually higher than they've been, the highest they've really been over the last several years, and especially when you look at the divergence between the mean 5 to 10 year inflation expectations and the median among the survey participants. What you see is there's a big divergence, and there's a lot of outliers, in terms of people expecting really high inflation. How can that be? And it's, how can it be? Well, it's because inflation is high, and it is a major problem, and a lot of the government statistics that measure it are not as reliable, and are subject to all kinds of adjustments and assumptions and different ways that the government has, whether it's hedonics or substitution, to keep the reported inflation down, especially because of the different government programs that are indexed to inflation, like Social Security and Medicare spending. And these cost of living indices, adjustment factors that are built into the social programs are all based on these government measures of inflation. But what matters about inflation, true inflation, what matters more than anything is consumers' expectations about inflation. And this is the problem. This is why the Fed has not been able to reduce interest rates this year. We came into the beginning of the year expecting 6 rate cuts, and it was a disappointment in the Fed meeting this week too. There was a hawkish Fed. People thought they were going to have the green light after the employment data, and after the inflation data in particular, that came out. People thought we were going to have the green light for the Fed to start, be more dovish. And we didn't really get it. So this is the problem we have. We really do have inflation that is persistent and stubborn. And once you get it embedded in people's consciousness that inflation is going to be higher for longer, that's very difficult to remove. That it's an inflationary pressure in and of itself. People's actions that they take relative to their inflation expectation. So 5.3% at the high end. So let's move on here. So as you know, I've been bearish. We've been bearish here at Crescat on mega cap tech, on large cap tech stocks. We've been calling for this great rotation out of overvalued large cap tech and large cap growth and mega cap tech and into undervalued commodities. We've been waiting for this for a long time. We're not giving up. Why don't we give up on this thesis? Well, because it's fundamentally sound, and we have the macro data to support it. This is, I talked about this one last week, but I have more data to support what I was talking about. And that is, when you compare NVIDIA today to Cisco Systems at the peak of the tech bubble in 2000, what you see is that relative to GDP, Cisco Systems, which peaked out at 5+% of GDP in terms of enterprise value to market cap in 2000. We have NVIDIA, which is now 11.4% of GDP, showing a very similar pattern, but an even bigger, bubble, if you will, in terms of how big one major infrastructure technology company can get in terms of its market cap and its share of the economy, relative to all the other spending. This is a bigger bubble, and this is one way of showing that this is a bigger bubble than the tech bubble. And it's not just NVIDIA that has a $3 trillion market cap now. There's two other companies, Apple and Microsoft, that have $3 trillion market cap. So they're also greater than 10% of GDP. And what's the problem with this? The fundamentals, they look good, on trailing, and the PEs don't even look, totally insane. But these companies have record profit share, have record share of spending of other businesses and consumers, overall spending. And people can only spend so much relative to the, there's only so much spending that can go to to one sector of the economy, to one group of companies, until you reach a point where you've had an unsustainable surge in spending and a top. And so this is evidence that we are near and probably right at that top. It's comparing it to Cisco with a 24.3-year lead. It's we think it's a bigger bubble today. And so let's look at my last slide here, which is the survey that just came out from a group called Lucidworks. And it's a survey of global companies on their AI spending. And 63% of global companies plan to increase their spending on AI in the next 12 months. Well, that sounds pretty good, but inflection is what matters. So that's compared to 93% of global companies in 2023 when they did the same survey, who plan to increase their spending over the next year. So what's the problem? The problem is that the financial benefits of these AI projects have been dismal, according to this study. 42% of companies have yet to see a significant benefit from their generative AI initiatives. So what's the problem? There's been this mad rush of spending, and NVIDIA has been the biggest beneficiary of it, just like Cisco Systems was the biggest beneficiary of it in the tech bubble in 2000. And NVIDIA is the biggest beneficiary today, but it's an unsustainable level of growth. And this is the bigger problem for the economy at large. And there's no return on investment in sight for all of this spending. And so naturally, companies are going to have to dial down their spending. And these are the kind of things that make major market tops. Look, we have, this is my last slide, but we've had this theme here at Crescat for a while, that we're going to see the rotation out of mega cap growth and into undervalued commodities. We have the setup with rising inflation. We have the setup with a potential major market correction coming here at the peak of an economic cycle. But this is a stagflationary economic cycle at the same time as we have this massive deficit spending and these government programs that are going to require more spending on commodities. And so we have the supply demand imbalances. We have the incredible low valuations. We have a killer long portfolio here at Crescat on the activist metals side of 78 companies in our activist metals sleeve, ultra undervalued relative to the resource value of the metal in the ground that our companies have created through discovery. of gold, silver, copper, yeah, we're positioned, we're waiting, and we think we're really close to this major inflection, this major rotation that we've been talking about. And if you're interested in learning more about this, do reach out to Merrick.